All right, we're here with Jim Steffler. Jim, thank you so much for joining me today to talk about co-buying. So happy to sit down with you, and this is a topic I've been, wanting to chat about for a long time. I think it's a missed opportunity in today's market as prices continue to go up. And so I'm happy that you can join us here today. Why don't you start by just introducing yourself, who you are, and give us a brief background as well.
Yeah, no problem at all. Thanks for having me today. It was either you or Jimmy Kimmel. I wasn't sure which one I was going to go on. And, I like the topic. So here we are. So I'm Jim Steffler, mortgage agent. Been around the industry for quite some time now. My deal is I like to think I'm a realtor's mortgage agent. So I love working with realtors and I love working with their clients. So that's kind of my thing. I love doing pre-approvals. I love doing approvals. I love getting people in houses. That's my thing. And kind of my sweet spot is honestly that first time, second time home buyer. That's the majority of my clientele and kind of where I like to play. I like to put people in homes. It's fun.
Awesome. Fantastic. Well, thanks for joining me today. And the topic at hand is co-buying. And I think that, if I rewind, I look at some of the most popular people that I know that co-buy or started their journey co-buying. You might have heard of Scott McGilvery.
Yep.
You might have heard of Skyline Properties. These guys at some point in time, they were students and they decided that they were wanting to own what they were renting. And they decided to pool their resources, pool their borrowing power, and purchase a home together so they can get in for the minimal amount of down payment that they possibly could get into it for and start to build up that equity. And they've done really well for themselves. And so I think that this is an opportunity that a lot of people that are out there might need to really get what they're looking for. So if you look at the average buyer that comes out that might not want a condo and they're looking at investing and all they can qualify for is a $400,000 condo, it doesn't fit their dynamic, doesn't fit their needs. What would it look like to possibly pool your resources with another person that has that similar ability to qualify for a $400,000 condo and then turn around and pool your resources and get an $800,000 home instead and get into a detached property, something that's going to build equity faster for you and be able to do it together. So from a mortgage perspective, when people are looking at co-buying, how does it differentiate from just your regular purchase? So I'm just a buyer that wants to come in and look at getting a pre-approval, look at financing a home. Obviously it's different when you're looking at it from adding another group of people into the equation with you. So how would it look?
I find lenders are pretty good. I find lenders are actually fine. I find the insurers are fine. And we'll talk about a couple of the areas where they maybe aren't. But let's say, Sean, we're good buddies. We like to go out. We have a good time. We decide we want to live together and just get into the market. Lenders are fine with that. We're both going to live in that home and we just want to pool our resources and pool our income and make that happen. I find zero issue getting it done. No problems at all. Here's where it can get a little dicey though, and I will explain this. Let's say said I was going to live in the home and you said, no, I'm still going to live at home with mom and dad. I just want to be more of an investor. Well, then we're off the rails a little bit, right? We might have trouble getting that deal done because then it's not two people with skin in the game, living together, paying the bills, mowing the lawn, doing all those things. Now suddenly one person's an investor, one person's not. A lender might find that troublesome because they don't want to get involved in that. The other piece, when we look at places like this, is that I sometimes find, people want to buy a student property, right? Because oftentimes at that point in their life, they're still young. They want to live near a university, live near a school, maybe bring in some additional roommates and have a bit of a student thing going on. That can get a little dicey too. So the location's going to matter. Because if I can be honest, a lender and the insurer, they don't want to hold a mortgage on Animal House, they don't want like Delta Chi to be their mortgage. So you want to make sure you're buying a reputable property, like a nice property. And you're both living there. And as long as you're doing that, really from a mortgage standpoint, it's pretty easy. It's really not much different than somebody buying with a girlfriend or boyfriend or the partner or whatever. It's viewed much the same.
Right. Awesome. And from a down payment requirement, does anything change?
No, not at all.
No.
Just, by the way, I'll touch on those rules for a second. It's
Okay.
5% of the first 500,000. Then if you go over 500,000, it's the 5% of the first 500 plus 10% of the difference. So just for our viewers here, if you bought a place for 600,000, then it's 25,000 from the first 500, and then just that $10,000 difference. So your total down payment would be 35,000 plus closing costs and all that jazz. And that's really it.
Wow.
Now there's new
Yeah.
rules coming. So eventually you're going to be able to buy over $1 million. I don't know what the down payment looks like on that yet. Those rules are still to be determined, but there you go.
Nice. No, awesome. So it really makes a difference. And when you're looking at, being able to expedite the process, if you only had, $15,000 saved up and somebody else had $15,000 saved up and you're able to pool those resources, it may have saved you some time. And in that time that you're still saving that down payment, you'll have secured the property and had the appreciation of probably a year, if not more, in the amount of time that it would take you to save that extra 15 grand. So
there's two reasons I see why people tend to do this. One is the down payment, right? Because let's call it doc. It's hard to save that amount of money. To save up $25,000 when you're just in the workforce, that could be a third of your income, right? Like that could be half your income, depending what your income is. So that's tough to do. So unless mom and dad are willing to kick in, and if mom and dad maybe don't have the resources to do that, a buddy is a great option. The other reason I see is sometimes just pooling income so that the person can actually afford something. And I'll use a real example. Somebody making 75 grand a year fresh out of school, they're doing good. They're 75 grand a year, like they're doing well. But from a mortgage qualification standpoint, they might qualify for like a $325,000 purchase. That's really it, because their income's just not high enough yet. So now they pair with another friend, which is also in the same boat. Suddenly 650, we can do something. We can get in the market. So those are the two reasons I really see, is either down payment or just pooling to make the income better so that you can qualify.
Awesome. Amazing. And do you see any financial, or what are the unexpected financial challenges that somebody might come up with when they're relying on somebody else that's, pooling resources with them?
Well, I find it's actually more of a general one. People always forget about the closing costs. They think, well, I'm a first-time home buyer, so land transfer is not going to matter, and this isn't going to matter, and that's not going to matter. And there is closing costs, for sure there is. I'll throw a couple which people always forget. Is land transfer rebate's great, but it's only up to the first $400,000 of your purchase, right? It's a $4,000 rebate. So that could still be a couple grand there. Or I'll tell you a sneaky one, is mortgage insurance gets put into the mortgage. So just for an explanation for the audience, if you need a CMHC fee, it gets baked into the mortgage. However, because it's Canada, we love taxing things. And there's tax on that CMHC fee. It's an 8% PST. So people forget that. That could be another $1,500. Or, here's a good example. If you buy this late in the year, the seller has already probably paid their property taxes for the entire year. So now you still have, October, November, December left. You got to credit the person you're buying the house from back their money. So, because they paid 3 months worth of property tax and they're not going to live in the house. So you got to give them that. They got to reimburse them for that. So that could be another $1,500. So what I find is almost every pre-approval call I take, clients usually know their down payment very well. But, if they have 25 grand in their piggy bank, they want to put 25 grand down on a house.
Yeah.
And in reality, they're going to need, maybe that's only 20 grand you can put down on the house because you're going to need the rest for closing.
Right. No, for sure. And then from a financial perspective, as you're carrying it, what should they be cautious of the other party that's in there? So, hey, I'm paying my bills, everything's good. Should I be concerned about any financial hardships or any additional debt that my co-buyer is taking on that might impact our mortgage renewals, that might impact, our entire deal that we have going on from the co-buying experience?
I think the main thing is just clear communication around what the plan is going forward with home repairs. You know yourself, there's always something. There's always something. There's always something going on in the house. There's always a timeline of something approaching, whether it's a roof or windows or what have you. And something's always breaking. It's a house, just the way it goes. Heck, my kids and my wife, cause all sorts of breakages around the house on a daily basis. So you want to have a good plan that, hey, when these things happen, maybe we're 50-50 or whatever that arrangement is, you got that clearly laid out and you both have a plan to set aside money. One thing I encourage people to do when they're doing this is to almost like create their own little condo fee. So, maybe each month, each of them kicks in $300 into a kitty just to help when big projects come up, or, even just that you can get things repaired and you take it from that budget, right? Something over and above the bills that if an unexpected repair was to happen, there's money up front, right? Because it's really easy to buy with somebody and maybe one person's great at savings and maybe the other person's not so great at savings and lives paycheck to paycheck, right? So I think it's important just to make sure you have that money set aside for when things do go wrong around the home, because they're going to. It's a house.
Awesome. No, I appreciate that. And one more golden nugget, I guess, that I'd love to touch on is accelerating the payments on your mortgage and paying it down faster. Because I know that, you go into this co-buying situation, eventually each party is going to want to split off of this and go do their separate thing. And if you could pay it off faster and be able to get a larger equity gain or pay down so that you have more equity opened up to you, I think that it would make it an easier transition to be able to go your separate way afterwards. From that perspective, what are some tips that you'd have on being able to pay your mortgage down faster?
Yeah, the easiest one is just to pay biweekly accelerated. And biweekly accelerated is just your monthly mortgage payments split in two. That's it. And because we all know there's those extra paydays per year, right? Those bonus paydays. Because you get those, you end up making one bigger mortgage payment per year. You make one monthly payment. This actually, though, over time, it shaves 3 years off a mortgage. Crazy. So it shaves 3 years just naturally. The other thing, too, you can do is you can up your payment a little bit if that's something you want to do. There's all sorts of tips and tricks. One thing I would recommend, and I'm kind of glad you touched on it, is I think you really want to chat with whoever's doing your mortgage. I know a really good guy, actually, for this, but you want to chat with them, and you kind of want to lay out your timelines and think about your strategy of exit. Because depending on the mortgage product, breaking a mortgage can be quite expensive, right? Like that can be a lot of money. So I think you want to be careful of setting it up that you could each get out of the mortgage without the penalty being so great. And I'll explain the why. It's really easy. I move in with Bob tomorrow. Bob gets a new girlfriend next month. Things go swimmingly. And then 2 years later, Bob's getting married and Bob doesn't want to live with Jim anymore. He wants to live with Sally, right? So you want to make sure that there's a good exit strategy in place that you can both go your own ways, take your equity out if need be, right? Kind of what that long-term strategy is.
Awesome. That's great advice. Fantastic. Well, thank you so much. Anything else that you would add to this topic? And where do you see the landscape going from home ownership around co-buying over the course of the next, say, 5 to 10 years?
Yeah, I think it's only going to increase, Sean. I think the nugget would be just make sure you choose the person wisely. Like you're going to live with this person, right? We've all had bad roommates. We've all lived with people which we don't love living with. I'd try and pick somebody maybe you've lived with already. So you kind of, yes, it's a great financial decision, but if the person drives you crazy, it's not a good lifestyle decision. And if you sell too soon, let's say it's only less than a year, well, you might actually lose money because now you got to pay a realtor to sell your house, all that stuff. So you want to choose the person wisely. I think that's very important. I think we didn't touch upon it because it's a bit of a different topic. I think one of the trends we're going to see in Canada is more generational living, right? Like where I live with mom and dad or grandpa, and maybe we buy bigger homes, but we get more house, more people living in it, right? And I think that's definitely a trend which we're going to see.
Yeah. Yeah, no, I think that we're going to definitely see more generational living. And I can remember, like I said, my parents coming over from Greece when they were young, little, or I guess my mom came over from Greece, and that's how they lived for the longest time. And there would be different generations of people living in the different floors of the house, and buy a duplex or a triplex, and everybody contribute to the overall bill. So
I think this is definitely a trend we'll see. Yeah, for sure.
Yeah, for sure. Well, I appreciate you taking the time to chat about this. And Jim, if anybody wanted to get a hold of you, how can they get a hold of you?
Yeah, easy. Look me up online if you want. Jim Steffler. Just give me a little Google. You'll find my website. Jim at jimstefflermortgages.com. Bit of a mouthful if I could go back in time and change that. Phone number 226-338-5136. You can find me on Instagram. You can find me. The kids like me on TikTok too, I guess. I don't know. I'm on all those platforms as well.
Amazing. Amazing. Well, if you want to reach out to Jim and you want to get started with the process and chat with the mortgage expert, definitely reach out to Jim. He's helped a lot of our clients in the past and still does help out a lot of our clients, and definitely our go-to when it comes down to mortgages. So reach out and let Jim guide you.
Love to help.